Hello, everybody. I'm Luke McCarty with McCarty Wealth, and I want to give you a market update for the end of May 2025. Our last video on our YouTube channel was in March. I want to give you an update now of what's been happening since we've had a pretty straight up V-shaped recovery in the market when you look at a chart perspective. And we are close to all-time highs. Back in the video in March, we put out, I thought we'd be at all-time highs by summer. We're really close to being there, and it feels like summer here in Florida, so we'll count it. But I think we're going back higher in the market. I'm going to show you some reasons why. One of the reasons potentially what the market could have not dealt with in the right way was the Moody's downgrade. So I believe it's a non-factor. If we look back at history, S&P downgraded from AAA to AA plus in 2011, right? Fitch did the same thing in 2023, and now Moody's finally caught up. There's three main credit rating agencies. Moody's is just kind of the last to jump on board of the downgrade. This is why this downgrade wasn't that important, because it was already expected. So the bond market's already expecting this, which is why interest rates were going up even before this downgrade, amongst other reasons why interest rates are kind of going up with U.S. Treasuries and government spending too much money. This is a rally against a consensus. So a lot of people are still worried about tariffs, still thinking the market's going to go down. We're going to buy the dip later. Well, here's a little brief history lesson since COVID. Right after COVID, the market, it was a rally that nobody liked. And then we hit all-time highs and the market took off. Then we had 2022, and the market started rallying end of 22 in the 23-24 range. That was a hated rally as well. Then the market took off once it hit all-time highs. Well, here we are about 3% from the all-time highs in the market here in the top right of this chart. And I believe it's very similar to these other rallies. When the consensus is against the market and the market goes up, there could be a lot of FOMO, there could be more buying in the market, and there could be some more legs left to this rally off the bottom of tariffs. Here are some reasons to stay positive in the stock market. And we talked a little bit about tariffs, but politics, the noise has been worse than reality. The markets are overreacting to the noise, while the backdrop of the markets remain positive. A most recent example is the EU tariffs. They were announced on a Friday, they were delayed on a Sunday, market went up on a Tuesday, right? The Doge cuts, less than expected. That is good for the markets and the economy to an extent, but I know it could impact the national debt, could impact our kids and grandkids in the future, but the government cuts were less than expected. The new budget, higher than expected. The government is still spending money. So the Fed is helping the economy. They're not cutting interest rates, but they're printing money. I'll show you a chart of the M2 money supply here in a second. And also the Fed is yet to cut rates. So we're looking into 2026 for multiple rate cuts. That could be a catalyst for growth in 2026. All the while, inflation is coming down. There's $7 trillion of cash on the sidelines. And the most recent hated rallies, right? Some of the cash gets back into the markets at all-time highs because of FOMO. Sure, it feels great to make 4.1, 4.2% cash, but not when the market's gone up 18% in the last couple of months, and we see it going higher by the end of the year. Our economic indicators, they're mixed, but still positive outlook, very similar to March video. So when these are mixed, we stay pretty level in our risk, but you can see housing is negative. Housing was positive a month or so ago, but now interest rates have gone back up, so housing starts are down. The civilian labor force, I'd say, is negatively trending, but barely. So unemployment went from 4% to 4.1%. That's a non-factor. Industrial production, retail sales, real personal income, those are all still positive. The federal money printer is back to printing again. This chart is the supply of M2 money supply. If you look after COVID, that gray vertical shading there, a lot of money was printed after COVID, a lot of money printed into 2022. Then the Fed came in, raised interest rates, actually took money out of the system. They were tightening. Well, now we're back to easing monetary policies. Our peak in the M2 money supply was April 2022. And just last month of this year, we reached a new high. The printer is back on. Do not fight the Fed. Stay in your positions or look to add risk as the Fed continues to stimulate our economy without really telling us. Thanks for watching. I'm Luke McCarty with McCarty Wealth. Email me, call me with any questions you have.